Presentation presented by AccessEHR Insurance Services. We are pleased that you can join us today, and we hope that you find this information educational. So to begin, HSA overview, health savings accounts. There's a lot of acronyms in my business, so please stop me or send me a chat just to reiterate any of these acronyms. An HSA is a health savings account. It's a special account that is used for current and future medical expenses. I like to personally think of it like an IRA. HSAs are used in conjunction with high deductible health plans. It does not cover first dollar medical expenses, so the plans itself have to be high deductible or HSA compatible, and they were created in Medicare legislation that was signed into law by President George Bush. Who is eligible for an HSA? Any individual that is not covered by a high deductible health plan, any individual that is covered by a high deductible health plan, not covered by other insurance, not enrolled in Medicare, cannot be claimed as a dependent on someone else's tax returns. There's no income limits on who can contribute to an HSA, and you don't have any requirement of having any earned income to contribute to an HSA. Who is eligible for a health savings account? Well, you're eligible, if you're not enrolled in another health plan. However, you can have AFLAC and EAP, dental vision. So there are other lines of coverage that you can remain eligible for, as long as you're not on another medical health plan. Eligibility for VA benefits, unless you've actually received VA health benefits in the last 3 months, then you would remain eligible for an HSA. So what is a high deductible health plan? A health insurance plan with minimum deductibles and out-of-pocket maximums. These are IRS rules. These are not AccessHR rules. They are simply by requirements from the IRS. A high deductible health plan can have preventative care covered at 100%. This was one of the nuances of Obamacare and the ACA, without being subject to the deductible. So preventative care meaning your annual screenings, routine prenatal and well child care, immunizations, etc. So it is definitely important to understand that every year you can go in for your preventative care, coverage at 100%, not subject to your deductible. And that was a big incentive and a big push for folks to join that HSA, because they still wanted people to to access preventative care. There are HSA maximums. The maximum amounts that can be contributed to an HSA from all sources, and so what that means when I say all sources, an employer and an employee, combined is $3,300 in 2014 up to $3,350 in 2015, and $6,550 in 2014 up to $6,650 in 2015. It's important to note these are January through January calendar year contributions. So if your plan runs, let's say on November through November of 2015, if you're on a November renewal cycle, you can contribute that full amount in November, and the full amount again come January. So they're the January maximums. They're indexed annually. Any individual that's 55 or older, you can make additional catch-up contributions up to $1,000. However, they must stop once you reach any type of Medicare eligibility. So once you enroll on Part A or any other parts of Medicare, your contributions must stop. And again, just to reiterate, HSA contribution rules, you can fund that entire amount in January, or, in December. So say your plan, you enroll in an HSA plan December 2014, you can dump that full amount of money in that HSA. Come January, contribute the entire maximum of 2015. The caveat to that is that if you decide to leave an HSA or a high deductible eligible plan and go to a traditional PPO or traditional HMO plan throughout the year, you have to be very careful if you've already contributed that full amount. You would want to be able to take back that amount up to that full amount contribution so that you don't have any penalties. And you could typically work directly with your banking institution, Wells Fargo, B of A, Sterling, et cetera, to be able to maintain your eligibility and so you don't have any tax implications. HSA contribution rules. It can be made by salary reduction arrangement through a cafeteria plan or Section 125. You can make those contributions via Section 125, and they can change on a month-to-month basis. That's unlike a flexible spending account or an FSA. So meaning you can put $1,000 in January, $500 in February, and then not contribute for the rest of the year. So you can make your elections on a month-to-month basis, and that can change. They are pre-tax, so they're not subject to individual or employment taxes, and the employer can automatically make cafeteria plan contributions on your behalf unless you complete a form saying you do not wish to have those elections made. And the only time you would want to do that is if you've already met your maximum, and so you just want to make sure that you don't exceed that. So you'd want to tell your employer, hey, you know, you can give me that amount just on a post-tax basis, or you can work something out directly with your employer so you no longer have those elections made. Very important contribution rules. Anytime with an HSA plan, you have to make sure that you're non-discriminatory. You have to make sure that all the employees are treated equally. A lot of people call me and they say, okay, well, I'm going to treat my HSA plan. A lot of employers, call me and they say, but I'm going to do something like with the 401k. I'm going to provide some matching. You can't do that. It needs to be simple across the board, non-discriminatory, and a set amount. Important to note, too, if you're self-employed or have an S-corp, you're going to want to look at how the organization is structured before the owner or partner begins taking those HSA contributions on a pre-tax basis. So that's something we can talk about individually with you. So just to reiterate what I just spoke about, they all must be the same amount. It can be a percentage of the annual deductible. So you can say, okay, my deductible is $2,000. I'm going to pay a percentage of that for everybody every month. And you as the employer can actually change that. So it's not like a 401k plan where once you set that amount, it's up until the next year plan document that you need to amend that. You can change it, again, as long as it's consistent and you give employees that information for them to know what you're doing and how you're doing it, you as the employer. Distributions. They're tax-free as long as you have a qualified medical expense. And the qualified medical expense must be incurred on or after the date of which the HSA was established. Let me give you an example. I enrolled on a health savings account on January 1, 2010. And I have not touched that money in my account, and I've maxed it out every year. So I've got, let's say, $10,000 in that account. I just allow the money to roll over, accrue interest, and just roll over year after year after year. What my husband and I do is we use it like a medical IRA. So we just put that money in the account and not touch it. Well, if tomorrow if my husband says to me, hey, we need that money, well, I can take out $10,000 because I have, on a tax-free basis, and it's not taxable, because I have a stacked envelope of all of my receipts to date showing that from 2010, I have paid $10,000 of medical expenses. So again, my HSA was established on January 1, 2010. I have funded it. I haven't touched the money in the account. It's rolled over accrued interest and grown over the years. Now I can take that out, and it is not taxed because I've used it for qualified medical expenses. Tax-free distributions can be taken for qualified medical expenses of a person covered by the high-deductible health plan, the spouse of the individual, even if not covered by the high-deductible health plan, or any dependent. So, for example, I'm married, I have a health plan, and I'm the only one on my high-deductible health plan for my work. My husband, he's on a Kaiser HMO plan. I can use the funds in my HSA to pay for his copayment. So he's not enrolled on my high-deductible health plan, medical plan at my office. But since he's my spouse, I can use the monies in my HSA to pay for his qualified medical expenses. Important to note, HSA distributions, if they're not used for qualified medical expenses, then it is subject to a 20% tax. So it would be subject to gross income tax, to your gross income, plus an additional 20%. Qualified medical expenses do not include other insurance. So you cannot pay for my husband's Kaiser plan, or for my dental plan, or my vision care plan. You can pay your COBRA premiums, though, out of your HSA. So I leave my office, or I'm terminated. I decide I really like AccessHR's medical plan. I'm going to continue that high deductible health plan. I can pay my COBRA premiums out of my HSA account. I can also use it to pay long-term care insurance premiums and certain eligible Medicare expenses. So it's very important. You can't pay Medigap premiums, and you can pay certain, again, Medicare premiums, but we need to be very careful. So once you reach age 65, you're going to want to work with a specialist in my office to discuss exactly what and what you can't use those HSA expenses for. Record keeping. The two things that I warn employers about, and first of all, I've been on an HSA high deductible health plan for several years now, so I'm an HSA advocate. However, there are two areas of an HSA that are negative. Record keeping is one of them. And the reason is because you, as an employee, not the employer, is responsible for the record keeping. So you need to keep all those receipts. You need to make sure that as the employee keeps them in that manila envelope, if they will, because if they are ever audited, the employee, again, not the employer, they're going to want to show that they use those distributions that, again, were not taxable because of medical expenses. We will, one question came up in a prior webinar that I did. They're saying, how many HSA audits are you really starting to see? And quite honestly, I have not heard of many, but I will be inclined to say that in the next several years, I would begin to start to see some of those audits coming through. And also, I mean, if you're only taking out $400 or $500 a year, I'm sure that there's not going to be a ton of auditing there. But if, like I mentioned earlier, I've got $10,000, $15,000 in my account, and I cash that out this year because my husband says we need that, then I'm willing to bet I probably will get some audit, and they will ask for some past receipts. To reiterate, HSA distributions can be used to reimburse prior year's expenses as long as they were incurred on or after the date the HSA was established. That's very important. Question came up earlier for me. Someone said, okay, well, last year if I begin my HSA on January 1 and fund the full amount, last year I had a lot of medical expenses. Can I just reimburse myself because of last year? And I asked them, were you on an HSA plan? They said, no, they were on an HMO. Then no, you can't reimburse yourself for prior years unless you're enrolled on that HSA plan. HSA accounts are owned by the individual, not the employer. So even if you as an employer decide, and we've got several clients that say, okay, to make it easier and simpler for all my employees, what I'm going to do is I'm going to set up a Sterling bank account with everyone's account number and routing number, and I'm going to just fund that. And I'm going to tell everybody in my office, okay, I want you to all set up Sterling accounts, and that's the way I'm going to fund it. We've got another employer. They have about 500 employees, and they say, you know, we're not going to set up one banking institution. We're going to tell you you can go out to wherever you want and set up an HSA-compatible bank account, Bank of America, Wells Fargo, Telco, et cetera. And you just give us that accounting and routing number, and we'll contribute to that. So you can do the logistics of setting it up. You know, we can absolutely help you through that. But it's very important to know that that is an individual's account. Once that money goes in there, you as the employer cannot take it out. So you can't use it in terms of any negotiations with the employees for severance or whatnot. But the company no longer owns that amount. It's in the individual's name. They leave the company. Again, that money is theirs. There's no use it or lose it like FSAs. That's the part that I love about my HSA. All the amount is fully vested. Again, it rolls over year after year. Depending on what banking institution you choose, you can invest that money. And I say depending because a lot of banking institutions require a certain amount that account before you invest it. There are some restrictions on it, but it's great. It's like a medical IRA, like I said, and you can invest that money. There are some rollovers from MSAs and other HSAs. And I also put here direct rollovers from 401ks. They're not absolutely not permitted, but there are some rollovers from IRAs, et cetera. So if you do have monies that you want to roll over, work with our office, and we can discuss about the specifics of that and what constitutes that eligibility. The impact of healthcare reform, there was two specific parts of the HSA that it impacted. Over-the-counter drugs are not a qualified medical expense for purpose of HSA distributions. I will tell you, though, if your doctor writes a prescription for over-the-counter, you can use your HSA dollars. So if your doctor says to you, every day you need to take 1 aspirin, and they write a prescription for you, you can go to the CVS and use either your debit card that comes with your bank account set up with an HSA, or you can pay the money and reimburse yourself out of the HSA. So again, as long as it's a prescribed over-the-counter drug, that's perfectly fine to pull the money out of your HSA. The tax penalty for distributions did increase from 10 to 20%, so that's very important that if you do take out that money for a non-qualified medical expenditure, it is subject to a 20% penalty. Okay, I went through that fairly quickly. I wanted to give you all just a very high-level overview of an HSA and health savings account. I truly believe in the next approaching several years, the HSA style plan is going to become more and more of a common thing that employers will offer. We recently did a benchmark comparison for a few of our very large clients that are about 500 to 1,000 employees, and the majority of their competitors all offered an HSA with an HSA contribution by the employer. So it is becoming more and more of a common medical program to offer, and it does put a lot of more of the control in the employee's pocket and the employee's hand versus in the insurance companies. So any questions that you have, I urge you to contact the benefits desk here on the screen, benefits@accessehr.com. There's a team of folks that are ready and willing to work directly with you on if you should offer an HSA and if it's something to consider, as well as any logistical questions on how to set it up. So I appreciate all of your time. Like I mentioned, this presentation is recorded and will be put on our website, as well as if you want to send that email to the benefits desk, we're happy to forward you that email for you to share or for you to re-listen to. Thank you so much and have a great day. Okay, well, I'm going to